Good afternoon, everyone. Thanks for taking your valuable time attending this webinar, COVID-19 updates and 2019 and 20 end of financial year processing. A couple of housekeeping items. Copy of the PowerPoint slide will be available download via webinar handouts. We'll also publish the recording of this webinar on class education website. At the conclusion of this webinar, we would like if you could take a moment to complete a short survey on your experience today. I'm very fortunate to have a panel of my colleagues and class experts, Carla, Chris, Lisa, Shah, and Sahia, answer any questions you may have throughout the webinar. I will pick a few as well to answer at the end of this webinar. As always, we'll send a summary of every questions to our and our answers from this session in a couple of days. This is the fourth year I'm doing end of financial year webinar for class. And this one is especially close to my heart, given so many of our clients are dealing with two unprecedented crises, a health and a financial one, both for your own practice as well as for your clients. I hope this presentation will help out a little bit to this course. For those who don't know me, my name is Kevin Zhang. I'm the Technical Service Manager for class for the last 11.5 years. For anyone who has attended my webinar previously, my session tends to be quite technical and very hands-on. So it is really aimed at experienced class users, self-managed super fund accountants, and administrators who have to do administration from beginning to finish. Quick disclaimer, the information provided today is general in nature, should not be relied as an advice. Some of the features and the functionalities may change and improve over time as we have taken into your feedback and suggestions. Today's agenda is quite packed. We did have a technical issue in April last time. So I will be recapping some of the key implementation of the COVID-19 related changes in class. This including the pension minimum reductions, the early release of super benefits for members affected by COVID-19. How do you add or make adjustment to the subsequent event notes, as well as the emphasis of matter paragraph in the audit report. Then we'll drill down, cover other COVID-19 related issues. The next part, I will be focusing on the what's new in the 2019 and 20 self-managed super fund annual return. While the changes in the annual return may be considered minimal, there are still rough, noticeable non-return related changes impact the self-managed super fund industry. At this point, I will shift my presentation into class application and go through a comprehensive case study on how you do asset segregation in class, as well as referring back to the previous contents presented. Last but not least, I will be answering some live questions related to any of the above topics covered in the session. Okay, pension review and 15% pension minimum reduction. Here is the new rates. The old rate is basically halved by 15%. Now, significant financial losses as a result of COVID-19 are negatively affecting account balance of some of the retirees' super pension or annuity accounts. So to assist retirees, the government has reduced the minimum annual payment required for account-based pension and other income stream products. You may think that that measure is a bit counterintuitive as to why they need to do this. So this measure is mainly designed to assist pension account balances to recover from unrealized losses associated with the economic shock of the coronavirus crisis. It allows retirees to reduce their pension drawdown, protect the capital values, and avoid forced sales of assets in a loss position to fund their compulsory pension drawdowns. Similar measures have done previously during the global financial crisis, specifically 2008 to 11, they had a 50% reduction, and 2011 to 13, they had another 25% reduction. Now, so what class has done in this area is that The legislation received the Royal Assent on the 24th of March. On 2nd of April, we did a patch release to basically allow new pensions created to have the 50% reduction applied automatically. We also released additional knowledge-based article in this area. Based on some of the clients' feedback, on 25th of April, we basically did an automatic recalculation of account-based pensions where they have done a pension review previously. The criteria for that automatic calculation is that the pension review has to be done for the 2019 financial year with end date at 30 June 2020. It has to be account-based pension, including TRIS. The pension review amount is based on the minimum rate on all rates, and there's no POIG included in the pension review. Now, I will briefly touch additional hints and tips on this area. So obviously, if you have transaction rules set up based on proportional method, you need to review those transaction rules and make changes accordingly. You need to review any non-account based pensions where class does not do the automatic minimum calculations, and where class has not automatically fixed some of the pension reviews previously, you also need to pay close attention. But this also presents a great opportunity to provide some value-added service to your clients. Why? So what I did was I list a couple of common scenarios based on your client base. What are some of the thinking behind those, and potentially additional advice you can do. So for TRIS clients, obviously, if they already exceed the minimum, you can consider ask them to stop the pension drawdowns. The exception is if they're doing a pension refresh strategy to rebalance the member accounts. For retirement-based income stream with with decent amount of accumulation balance, then after the 24th of March, based on what you had in the original pension documents, some of the payments you may consider to do as a commutation from the accumulation rather than, as a lump sum from the accumulation rather than continue to draw down the pension amounts. For retirement phase income stream with no accumulation balance, you may consider stop some of the pensions and consider do a partial commutation if they still need the money. And for all income stream recipients under the age of 65 previously, so amount over above the pension minimum can be potentially recontributed to the fund subject to the contribution limits. The next measure is on the early release of super benefits for members affected by COVID-19. So I won't go through the eligibility. If you've got a copy of the slide, you can read it yourself. But what I want to touch base is, noticeably, it's based on the working hours reduced by 20% or more as one of the criteria. So it's not necessarily the income reduction, but the working arrangement. But what I want to focus is the process. So the process for anyone who want to apply this early access is the members have to submit an application via MyGov to the ATO. ATO will make a determination to approve or reject the application within 2 to 3 business days. Once the member receives the determination, successful determination, they can forward that to the trustees or the administrator of the super fund. The administrator or trustee of the super fund can make payment, use the new condition release that's provided in class, and document that via minute resolution. The money will then need to be transferred from Xiamen Super Fund bank account to members' personal bank account. Now, what class has done in this area, on the 24th of April, we actually did a release on this with a new condition release called Compassionate Ground Coronavirus. It's available for any payments made after 20th of April 2020 before 30 June 2021. Now, interestingly, the actual application for that payment is only available for 6 months. So that means by 24th of September 2020, and that's the last opportunity for a member who is eligible to apply for that early access. The payment is based on a proportional rule of your tax components. There's no PAYG lump sum payment summary required, as the payment is treated as tax-free. we have put validation in place to prevent clients to process multiple lump sum payments using this conditional release, and the maximum amount cannot exceed 10,000 per financial year. And we also update a bunch of user guide knowledge base, as well as a very comprehensive FAQ on this topic, which you can access through our help center. Now, if you do process this payment, then it will be treated as a lump sum payment. The benefit code is F, other lump sum benefit type, particularly the one related to approved compassionate payment. Subsequent events and emphasis of matter. So this is predominantly driven by auditors' requirements. So COVID-19 has been identified as being a non-adjusting subsequent event to all years ended prior to the announcement of being a pandemic from March 2020. Given we're still in the middle of this pandemic, it is reasonable to argue that impact for 30 June 2020 cannot be ascertained. So most auditors probably will argue appropriate disclosure recognizing the full impact of COVID-19 is unknown at this stage and should be included as notes to the financial statements. And auditor may also draw attention to the auditor report and document their concerns in the engagement letter on the ongoing viability of this fund. So what I did in this table is I summarized the impact reports, so notes to the financial statements, audit representation letter, and the auditor's report. What class has done. Basically, for subsequent event note, we'll fix the bug about numbering, so the numbering now is in sequence. You can also change the wording, customize the notes to the subsequent event notes. And we'll go through that later in the case study. If you want to change the audit representation letter, there's another knowledge base article. You can use that as a template to do this. And finally, the emphasis of matter based accounting paragraph can be modified since the June release. Okay, other COVID-19 related measures for self-managed super funds. So most people probably are already aware there's a bunch of reliefs has been documented in the media as well as by the ATO. So the first one is related party LRBA limited recourse borrowing arrangement loan repayment relief. Basically, just to be aware, it's a temporary loan repayment deferral up to 6 months. Unpaid interest need to be capitalized on the loan. The rental relief, so ATO has said that they will not take any compliance actions where self-managed super fund provides a tenant who is a related party to the fund a temporary rent reduction, waiver or deferral for the 2019-20 and 2021 financial year. If it is not related party tenant, then you need to document the relief arrangements, provide a commercial justification with a clear reasoning as to why such arrangement is the best interest for the self-managed super fund for the purpose of providing the retirement benefits for the members. 5% in-house asset relief. So if the 5% in-house asset value was temporarily exceeded due to adverse market valuation on the investment portfolio, ATO will not take compliance actions for the FY 20 and 21. The residency test relief. So the 2-year temporary residency rule was inadvertently breached due to COVID-19 travel restrictions. Again, ATO will not take any compliance actions on this. And lastly, just be aware, some of the accountants without financial service license will be able to provide financial advice to clients accessing super benefits based on the relief provided by the ASIC. Now, what class has done in this area? We identified there's a huge amount of needs on documentation on this area. We engaged a lawyer that worked with us for the non-infinity products. So we come up a couple of templates. It's basically freely available in our help centers. So there's a rental relief documentation, there's LRBA loan repayment relief documentation, as well as the super release documentation. So this one was based on the existing class lump sum minutes and resolutions for the early access. However, it's further improved, taking into account some of the client's feedback. So this one, we removed the reference for PAYG withholding as the payment is tax-free. We also made it a bit more generic for non-infinity clients, where it made a reference to a temporary member statement or member estimate balance. So that's been removed. It made a reference to the ATO determination process, as well as a payment of benefits to a member's nominated bank account. So it's basically targeted to be more generic use. Now, next part, I will briefly cover through what's new in the 2019 and 20 self-management annual return. So this change is one of change. Class have been lobby the ATO to fix the wording on these questions. Previously, there was a lot of confusion if you did a Part A qualification, whether this question label D need to be answered. So now it's very clear. So only Part B is the compliance audit. If that's qualified, then the question, have the report issues been rectified, need to be answered, yes or no. If Part A is the financial report qualification. If that's answered yes, you don't need to answer label D. However, ATO well taking into account that answer for the risk profile, in case they need to do audit on this fund. Electronic fund transfer details. Again, this is a measure class have been lobbying the ATO to make changes for a while. The change actually happened in the 2019 self-management annual return. So for the 19 return onwards, the bank account name has increased from 32 characters to 64. Death benefit increase. So this label it has been removed in the 2020 self-management annual return. This was a change announced in the 2017 budget. Basically, for a member passed on before 30 June 17, the benefits need to be paid prior to 1st July. So they get 2-year time to make the lump sum payments. But from 1st July 2019 onwards, the deductions are no longer available. Section H is the assets and liability section of the annual return. So there's a new label for the property account, but be mindful that you only need to put property account if the property is subject to limited recourse borrowing arrangement. If the fund owns the property outright, there's no requirement to putting anything in this box. Lastly, so ATO has deliberately removed the wording "if required" in the trustee or director's declaration. This is to remind trustees or director of corporate trustees, when they sign the trustee declaration they return, they are confirming they have received the self-managed super fund independent audit report and are aware of any matters it raises. Now, if trustee signs this before receiving the audit report, there is potential penalties up to 12,600 for false and misleading statements. Okay, now we're going to drill down to the non-return related areas in the self-managed super fund industry. The first one is the bold and scope of non-arm's length income. So this is actually law from 1st July 2018, NALI. So it's burdened to include income amount derived from self-managed super fund where the income was derived under a scheme in which parties were not dealing with each other at arm's length, and the self-managed super fund incurred expenses, outgoings, or losses that are less than the amount it might have been expected to incur under the normal arm's length arrangement. The new expenses or not charging the fund at all is also considered as non-arm's length expense. Now, the good thing is ATO has come out to say they will not allocate any compliance resources to determine whether a NALI provision applies for the 18-19 and 19-20 financial years. If the fund incurred the non-arm's length expenses of a general nature and has sufficient access to the ordinary or statutory income of the fund. So the example they gave in the guide was the accountants providing their expertise in this area to do the administration of the super fund. Now, just be mindful is if the trustee is acting in the capacity of trustee, there's no issue whatsoever. But if they're acting in the capacity as a contractor, then it has to be done at arm's length. Otherwise, potentially will trigger these the non-arm's length expenses. This is a positive change, lifting work test exemption age from 65 to 67. So from 1st July 2020, they have legislated to increase the age in which the work test starts applying for voluntary contributions from 65 to 67. They also propose to increase the non-concessional contribution bring forward rule option for members over 65 but under 67. However, the legislation has been proposed, not yet passed. Finally, they're increasing the age limit for spouse contribution from 69 to 64. Now, this change, combining with the carry forward unused concessional contribution and the removal of 10% income tax since 1st July 2017, will provide a very good opportunity for anyone approaching or recently retired to implement voluntary super contribution strategies over a much broader time frame than previously allowed. Now, particularly where you want to rebalance a member's account for what I call a lopsided super fund using recontribution strategies. Lopsided super fund where a member A has, say, a balance of $2.5 million and member B has balance less than $500,000. So you can potentially use recontribution strategy to even out the balance. So hopefully they both reach to 1.5, 1.6 million by the time they enter retirement phase. Okay, what class has done in this area? So in July release, so hopefully by this Friday, class will include this change. In the fund dashboard, member contribution events, you will get a warning message, contribution cap screens, contribution reports, and client view, all of them will be changed. The bring forward rule arrangement, given it's not yet passed the legislation, we have specified what's required, but it's not deployed until the law passes. So that will have impact on the member console for the business and the fund level, as well as Excel transaction loader, where for some people not aware, we recently updated Excel fund loader. You can record for take-on funds, you can record unused concessional contribution carry forward, as well as the existing bring forward rule details through the fund loader. Okay, so ATO has issued a new independent audit report. So I won't go through exactly what's written on this screen, but I'll briefly summarize. The motive behind this change is to make sure the template is consistent to the audit requirement for APRA funds. It's incorporating the independence standards from APS 110, Code of Ethics for Professional Accountants, and reordering some of the paragraph when auditor is doing qualified opinions. Noticeably, none of the CIS Act and CIS regulations in the audit report have been changed. What CLAS has done in this area, so in June release, CLAS has released a new audit template affecting, as well as fixing the issue affecting the emphasis of matter paragraph. Tomorrow's release, we will hopefully further improve this report, taking into account some of the client's feedback. In August, potentially September release, we will update both the audit engagement letter and the audit representation letter to be consistent with the new audit template and GS 009 independence requirements. Now, this is another surprise. So changes in the cap defined benefit income stream. The law has been passed and received Royal SM. So basically they provide a new way of calculating a debit value, which previously has been problematic for some type of cap defined benefit income stream, particularly the market-linked pensions. This is due to a defect on the existing legislation where the debit value is effectively zero. So the new approach to calculate this has retrospective application date of 1st July 2017, where one of the pension is commuted, and then the debit value is calculated by the original special value as reported from 1st July 2017, less any amount of transfer balance debits that risen from previous transactions. The example they're given was, for example, family law settlements, less any income stream payments have been made to the members from previous years. In the year it's doing the commutation, then you need to take away the greater of the actual payments made during that financial year or the minimum pension amount. So here's an example how the new debit value calculated. So this is an example from the explanatory memorandum. Daniel has market-linked pensions on 1st July 2017 with special value of 1.8 million thereabout. There's no other subsequent debits arisen since that day. In 2017-18 financial year, it made a pension payment of 91,000. That's required. Then it's doing a full commutation on 30 June 2019. You need to do a you need to do a calculation to assess the greater amount of Daniel's minimum pension based on the existing regulations, as well as the actual payment they made. So in this case, it's 91,941. So if Daniel is doing a full commutation on 30 June, the debit value from that commutation is 1.646 million. There's a typo. On 1st July 2019, Daniel has used the money to start another market-linked pensions, but the actual balance of that is actually 1.2 million. So the 1.2 million is the new TBAR credit, and the difference between 1.9 and 1.6 adds another about 200,000. So the current transfer balance account for Daniel is $1.4 million. Now, this is a summarize of type of captive fund benefits in class and potential impact it will have. So obviously for market-linked pensions commenced after 1st July 2017, then those debit value will be the actual commutation amount. For market-linked pensions starts on or before 30 June 2017. And in class, we call it compliant pensions. But if it's a life expectancy compliant pensions, then they have to apply the new formula. For a lifetime compliant pensions, then continue to use the special values. Now, at the moment, class still analyzing the full impact of the new legislation, how it's potentially applied to some of the commutation events you process in relation to those type of income stream products. Just watch this space. Hopefully, it will cover in the release notes in August or September, the release. Now, we'll go through asset segregation in class. So it's an area where we generate a lot of support costs, and there's a lot of queries on this. Segregation is conceptually easy, but it's actually quite difficult when you actually implement in practice. So I'm going to go through class and see how we do that segregation. Okay, so the case study is a super fund. I call a New Horizon super fund. Two members, Tom and Isabel. Tom is in 68. He's in retirement phase with two pension balance, 1,500,000, so 1.5 exactly. Isabel, she's 61. She's got 300 in accumulation and 600 in trees. So total balance $2.4 million. The assets is currently supported by a share portfolio worth, so all the shares in listed companies was $1.2 million. 300, so the bank account consists of 100,000 for Tom, and there's a term deposit 200,000. So 1.2 plus 200,000 term deposit plus 100,000 is 1.5. For Isabel, she's got a property of $1 million, but with LRBA of 400,000, so the net is 600,000. She also got managed funds and ETFs, exchange traded funds, worth of 250K on a platform, BT Wrap, and a cash account of $50,000. So that made up exactly 900,000. So this is the rough structure. What I'm going to show you, the first thing to do asset segregation is review your fund policies. Now, given Tom only got $1.5 million in pension phase as at 30 June 2019, he at this stage doesn't have any other balances, so he has not exceeded 1.6 million. So he's eligible to do what we call elect segregation. So in fund policies, you go settings, fund defaults, you create a fund policy. Here's the existing one. Although the standard one, the system will not make this segregation available. But if you want to do elect segregation, you need to change asset segregated for pension. Flag that as yes. Save that. Now, it's good practice to do a fund policy each financial year, even if they're the same information, okay? Let's close this. The next thing you need to do is review the asset structure. So to do segregation, you need to go to browse holding accounts. This is what I've created. So everything, as you can see, the asset pools is in default pools. Now you have, I have the share portfolio is from Bell Direct with all the holding reference set up, and the wrap platform is support Isabel's balance with the BT wrap account. Okay. There's obviously the property, term deposit, and ARBA. They are not linked to any holding references. Okay, let's do asset segregation. So asset segregation is done through investments, maintain asset pools. Okay. As always, the best practice is create a new pool structure each financial year, and I'll call it segregation, safe. So you get a warning saying, yes, you create a structure, but you haven't really done any segregation yet. So basically, the way class has designed it, we've got a summary, screen, tab, member accounts, holding accounts, and holding references. So let's add, so by default, everything goes to default pool if it's unsegregated. But what we want to do is segregate the pension pool for Tom's 2 pension accounts. So let's add a pension pool. And you ask to create default pension pool. If you say yes, that's the one you want. But if you have multiple members with multiple pension accounts, potentially you can create separate pension pool for each of those pension accounts. For the moment, I will just create a default pension pool. Now, the systems automatically move the 2 pension accounts into this pension pool. Now, if Isabel has actually got a TRIS account. So if I can move the TRIS to the pension pool, it won't let me. You'll get an error message saying you cannot put a TRIS account into a default pension pool. So TRIS from 1st July 2017 onwards has to be in the default pool. Okay, so that's the accounts. So even though Tom's accumulation is 0, it needs to be in the default pool to be effective. And his pension accounts is currently in the pension pool. Now, let's move in the holding accounts. So you can sort the holding reference. So I want to move anything that's belong to Bell Direct because that's the share portfolio support Tom's pension accounts. So I tick that. So there's 15 assets, 16 investments selected plus the bank account plus the term deposit, and I move selected. So I'm moving the default pool. Okay, let's quickly review. So the LRBA, the property, and the BT wrap accounts belong to Isabel's accumulation and the TRIS. That looks fine. And then review the pension pool. You got all the Bell Direct accounts, the term deposit, and the Macquarie Bank account. Looks good. Holding reference, again, you need to move holding reference. So Bell Direct, you need to move that to the default pension pool. This way, when Tom buy or sell more assets, investments, it will automatically create flagged into pension accounts. Okay, now let's go back to investments, browse holding accounts, and quickly have a look. Okay, and again, you will see now you have a default pool and default pension pool. Okay. At this stage, I'm going to show you the pension minimum reductions. So let's just go to one. So the pension minimum applies to all account-based pensions, including TRIS. I'm just quickly show you a TRIS situation. So remember, her balance was 600,000 at 2.5%. Sorry, at 2% is 600,000. 2% is 12,000. Obviously, TRIS used to have a maximum of 10%, so that's 60,000. So it's calculate. Yeah, that's calculated automatically. The other thing I want to show you related to COVID-19 is the, unfortunately, Isabel got affected by COVID-19. Her hours was being reduced. She has applied to have the early access. Let's go to my transactions. So there was a pension, payment of $10,000 on the 26th of June 2020. Let's create the lump sum payment for that using the new condition of release. This will be member payment. Yeah, roll the lump sum. Select Isabel. Payment day is 28th of June. Description will be, I'll just call it COVID-19. Sorry. COVID-19. Conditional release. So make sure you select the right conditional release. This will be compassionate ground coronavirus. It's a partial, obviously, cash proportional, and the payment is 10,000. Okay. It's automatically taken from the preserved components, and her accumulation balance doesn't have any tax-free components. Otherwise, it will be using the proportional. All right. Once you're happy, you submit that. Okay. You can also go back to browse events and print the lump sum events, lump sum minutes and resolutions from that pack. Then the next part, I will briefly go through the concept of the difference between investment expense and fund expense. So the investment expense will be linked to the actual investments. And fund expense, unfortunately, you don't need to select an investment. The system will do basically member weighted average balance to allocate that proportion. Now, let me quickly show you. I already posted most of the events. So there's one event, an advisor fee or platform fee that relates to the wrap accounts, but it's processed as a fund level type of expense. So obviously that's not ideal. We want to change the allocation from a fund level to Isabel's account. So this is the advisor fee. Sorry, this is auditor fee, advisor fees here. $5,000. So by default, the system will using a fund allocation, but you can also change to a particular member's account. So in this case, I just want to use Isabel's accumulation balance. And you can do that for most of the fund expenses. And some clients want, for example, accountancy fee, even though they're paid, they want to split 50-50. You can do that as well. But obviously you have to process 2 accountancy fee instead of 1. Now, the next thing I want to do is I'm going to run peer update and I'll show you a couple of reports and benefit allocation as well. So the share portfolio, mostly the income will be dividends, and you get it because I purchased the lump sum payment. It wants you to run a peer update to 27th, but partial lump sum payment is actually you can actually override that. Okay. So the first thing I want to show you is the benefit allocation. Now, as you can see, most of the share portfolio is not doing particularly well in this example. That's why the Tom's pension account got a hit with the losses, whereas Isabel's platform account is actually doing fantastically well and getting a lot of profit allocation. Below shows how we do the benefit allocation. So the member weighted average balance calculation here. This is the profit loss in loss situation allocated to Tom's account, and the investment income allocated to Isabel's account. Now, the fund level is the one I want to show you. So most of the fund expenses relate to the accountant's fee and auditor fee of $3,800, where proportionally allocated to members' account, but there's a 15% tax benefit automatically applied to the accumulation. Now, I override that 5,000 allocation to Isabel. You can see that 5,000 goes to her accumulation account. And residual tax is basically some sort of tax adjustments we do to reconcile back to what the actual provision for income tax is. So by default, with the exception of if you're using net franking credit methods, there's no tax allocation to the pension accounts, and then they will proportionally allocate to the Isabel's accumulation and trust balance. Now, obviously, you can still make adjustments, and The next thing I want to show you is run a couple of reports to see whether the actual calculation makes sense. So the first one I want to run is the capital gains, realized gains report. The reason I did sell some shares, some Macquarie shares, as well as some Vanguard ETFs during the year. So if you remember correctly, Macquarie shares will be related to Tom's pension balance, which is segregated, and the ETFs. They both were sold for a large profit. But once you have an asset that's segregated, in this case, Macquarie, for example, they made quite decent profit, but the capital gain for segregated assets is completely disregarded. For Isabel, she made another fantastic gains on her Vanguard ETFs, VTS. Then you've got, it's a discounted gains, and you will have 1/3 discount applied. So 47,778. So that's a different treatments for assets that's sold in segregated pools, or segregated pension pools, and versus assets that's in the default pool. The next thing I want to show you is the statement of taxable income report. Okay, why this report? So this is probably one of my favorite reports, because it's quite comprehensive and break down a lot of information for you, particularly on the exempt current pension income calculation. Now, the capital gain, we briefly cover that. There's some rental income, but remember the property is only linked to the default pool, and therefore the whole property income is there, and the gross interest. Okay. Now, what I want to highlight is here, where we show the exempt current pension income. So the exempt current pension income effectively is the gross interest related to the term deposit of $8,000, the franking credits, the franking amount, and unfranked credit. So all of them basically relate to the share portfolio for Tom's pension balances. They form your exempt current pension income. So in this scenario, obviously you don't need an actuarial certificate system. Will calculate CPI based on the segregation strategy you put in place. Everything else will become taxable. The rental incomes, the income that you derive from the managed funds and the ETFs. We still do a fund expense apportionment, which you can see the breakdown how we do that calculations. But obviously you can see, for example, investment expense, here are processes that few that relate to the rental property. They are fully deductible because it's supported by the default pool. Whereas the audit fees, accountancy fees, etc., they are proportionally allocated to adjust the exempt current pension income factor. Okay. Now there's another report I recommend you run if you want to do more reconciliation between the allocation. This investment income summary report. So investment income summary report, you can actually run by asset pools and preview. So it will group by the default pool will obviously support Isabel's account, and you can see most of them are to do with all the so the default pension pool will to do with the dividends, which is 51,000. The default pool will support Isabel's account, and mostly will be the ETFs and the managed funds of 55. So you can also run investment valuation report and do that grouping as well. So this way, basically can reconcile exactly how much was allocated to each member's account. Now, I want to touch base on the report pack and particularly the subsequent event notes. So in order to do report pack, you need to go to business level. So what I did was I have existing 2019 and 20 financial statements. So this is a standard report pack without, subsequent event stuff. One of best practice you would do is actually clone this report pack and make another one. So what you do is you go to summary, clone. It will call a copy of the 2019 and 20 financial statements. I will just call it COVID. Save. Now in this report pack, I have, it's very simple: statement of financial position, operating statement, notes to the financial statements, member, and audit report. So what I want to show you how you do the subsequent event notes. So the subsequent event note is here. Now we have a knowledge base article give you existing template that you can use. Okay, let me see. So let me just save it. And not sure what happened there. Notes to the financial statement. Okay. So I'm just waiting for the screen to show. Not sure why it's not showing the screen for me. Okay, let me just close that and go back to report pack again. Apologies. So to access report pack, you have to go to the business level, maintain report pack. So subsequent event. Okay. There's a bit of a refreshing issue that couldn't display, but here it is. I can. So there's a knowledge base article that we have pre-existing wording that you can use. What you need to do is copy and paste the wording and paste here. So the font needs to be Arial and not size 9 or 10 should be fine. And then once you're happy, you click OK. And then you can also do the change for the emphasis of matter paragraph. Now I just got the wording here. So the emphasis of matter wording, again, it's Arial, but the size is 10. Okay. Once you're happy with the change, click Save. Save the report pack. Then this report pack can be used by any funds want to use adopting those specialized notes. So we'll quickly go run this. So it's running. Let me just make it slightly bigger. Now, the beauty of running report pack is that you can do for multiple funds as well as a single fund. And you can create a pack for the funds you don't believe COVID-19 has impact on it, or you can create another one that inclusive of COVID-19 has an impact. Okay, and then you click download. Let me quickly show you the pack. So node 9 is your subsequent event node, and the auditor report now has the emphasis of matter paragraph. Now it's in there. Okay. The next thing I want to show you is the changes in the annual return. So I already finalized the accounts, and I'm just quickly show you the tax return. So let's view tax return. The 2020 tax return, so what I want to show you is I processed the lump sum payment for Isabel. So, and that should be at $10,000. You need to select the benefit code F. And for she's got an LRBA a property of $1 million, and the property account now has account indicator of 1. So and the last thing I want to show before I move to live Q&A is that now if this is the difference between asset segregation for ECPI purposes versus as investment choice purposes. Let's say if the member Tom Ashley's got a balance as at 30 June 2019, he's got external balance which bump up his ECPI, his total super balance over above 1.6 million. Given he has got retirement phase income stream previously, then it will be treated as disregard small fund assets. Let's select the financial year. Edit. Whether the balance is in accumulation or a retirement phase, it doesn't really matter. Let's just put $200,000. So that will increase his balance to 1.7. As at 30 June 2001, 1.7. Now, I want to show you our exception reports. Ignoring the tax statement stuff because I haven't processed a tax statement yet, but notice there's electric segregation. The fund is ineligible to use electric segregation because its total super balance is greater than 1.6 million previously. So you need to review that. So what you need to do is to reflect. So you can still keep do segregation, but what you can't do is segregation for ECPI purposes. So you need to change the fund policy. In this case, change that to no, save that, then rerun the period update for 30 June 2020, go apply an actuarial certificate, then it will calculate the ECPI based on the pension balance. So you effectively still doing segregation, but that's segregation for investment choice, and let the actuarial certificate process to calculate the ECPI. Okay, now let me go back to the slides. I won't go through the final takeaways, but basically I pretty much cover those through my demonstration. What I want to do is moving to the live Q&A process. So this concludes the formal part of my presentation. For anyone who has to leave now for other work-related commitments, I would like to take this opportunity to thank you for your attendance and wish you and your loved ones stay safe and well. For people who still want to remain, we will do the live Q&A, and I will try to answer a couple of questions. Thank you. Okay, there's a question about whether you need a separate bank account. It's a good question. So to me, it's best practice to have separate bank account. Although bank account itself, predominantly if the bank account is used not for investment purposes, they are mainly used to receive contribution, make payments, and for the normal day-to-day operation of the fund. Then it's not really required. I will normally by allocating the bank account to the largest balance, whether it's in the pension or accumulation balance, it does not matter. But obviously, if you have separate bank account, like what I demo in the case study, it's probably the best practice. But I cannot stress the importance of a separate HIN numbers or account numbers for different portfolios. This way, when they buy more shares, we're automatically creating the right portfolio without you shifting assets between different pools. So remember, members' balance is predominantly driven not by whether they have whether they have a bank account. It's important, but it's driven mainly by the income and expenses. So if the bank account is not the one that derive investment income, it's really immaterial. Is audit report compulsory by the ATO? Yes, from 1st July 2019, you have to use the new template. Now, if you for whatever reason you're still doing a very old seminar super fund audit, be mindful, particularly I think prior to 2016, some of the CIS regulations references may be slightly different. You need to add the extra CIS regulations into the audit template, but you're still using the new template. How to do, it's another good question. How do you actually do adjustments or benefit adjustments? So let me quickly switch to class. So this is done when you run a period update. So view / rollback, allocate benefits to members. When you click edit here on the top, then the columns to do with profit and loss and the fund tax allocation can be adjusted. As long as the total amount is the same, then you can do whatever allocation you like. Then the members' statements will reflect that allocation. Just be aware of some of the what I call tax allocation anomalies in class, where, for example, if you're changing from tax accounting from yes to no, some of the writing off deferred tax assets, we will automatically apply only to the accumulation interest. The other example is foreign tax credits write-off. We tend to write off against the accumulation interest, but really, if you think about it, it's the pension balance don't normally trigger that write-off. So some people may argue it should reflect in the pension accounts. So in this scenario, in most cases, they're not material, but if they are material enough, you need to make adjustments in the screen that I just showed you. Last question, do we do partial segregation? So at the moment, there's no easy functionality to do partial segregation in class. There are workarounds. We can kind of mimic what's required when you do the allocation. But at the moment, partial segregation itself it is not supported. But if you contact our support, we will, based on the scenario, we may give you a workaround to achieve the segregation objective that you have. As always, segregation, it is complex. Well, notionally simple, but when you do it, it's actually quite hard. Like I did hear like some of the feedback from clients where people want to do segregation because they don't want to set up another super fund, pay double the levy, double the setup cost. To me, administration costs should not be the main drive that you want to do segregation or not segregation. It should be purely based on clients' investment objectives. And obviously, it's very important to review members' total super balance every beginning of every financial year, and to make sure they're not falling into disregard small fund asset category, where you can't do what we call elective segregations scenario. Okay, that concludes my presentation. Thank you very much. Have a great afternoon.